a mix. Obviously, it won't be a single biggest factor, but as important, I mean, is that a strong enough important reason, coupled with the fact, Aditya, that now, again, as one of the other charts in your report shows, India's weightage in the EM basket as well for passive flows too, right? Much higher than what it used to be. The differential much lower versus China. So whenever the EM flows gush back, presumably post the rate cut or otherwise, does that also aid the probability of flows? So higher ROEs, more weightage, stable earnings growth, does all of this augur well for flows? I'm just trying to understand from somebody who looks at this more closely and is more informed than most people about when do foreign flows make a comeback.
But I think that's exactly it, right? So I don't think India on its own, at least in terms of foreign liquidity dynamic, just going back to 2023, right? Yes, we saw a lot of flows coming in, but the backdrop was that EM ex China as a group saw a lot of inflows, and within that we saw a greater capture of those flows, right? So I think the starting point has to be that EM ex China as a category is going to see more inflows, and within that, I think India will continue to stand out as a benefactor of these kind of benefactor of these flows. But I think as a category, as a group, we've got to see the inflows first. I don't think India on its own is going to see foreign allocations expanding, at least from foreigners.
Got it. Okay. Aditya, where do you think money flows in? I mean, what is the top sectoral thematic bets that Macquarie is laying out at the current valuations?
So if the question is about the foreigners, the problem has been that...
No, sorry, Aditya. Aditya, actually the question is really about what is in your head, what is it that you think are the best bets? I don't know if you are essentially looking at strategy, thinking about those lines, but if you are, would love to know that.
Yeah. So when you kind of tie all this back in to the bottom up, thinking about what's in earnings expectations, where's the risk, so on and so forth. As a general point, Neeraj, what I'll make is that we're finding that sector type of top-down call much harder to take today than what it was, say, a couple of years back, where we could have given you some view about financials and industrials, all these things. Today, at a point in time, we're not seeing clearly any of the sectors where earnings estimates is going to be revised upward. So if I was using that as a proxy to think about where should we be incrementally positioned over the next 8-12 months, our honest submission is that across sectors, estimates are full. Within that backdrop, then it becomes about where in relative terms do we see or have a bit more confidence compared to consensus on how these estimates could shake up, and then kind of overlaying valuations as well. So the private sector banks looks really interesting, given the steep valuation disconnect here. Whilst we still think that there are compounding characteristics. Beyond that, I think the telecom sector has done well. I still think there's a path where the incremental returns are going to meaningfully improve over the next 2-3 years. The IT sector, I think, is one where, if anything, we're probably a bit more optimistic than where the street is at on both the recovery as well as margins. And that's kind of one where positioning is relatively mild as well. So if you want a contrarian-ish kind of couple, it's more the IT space where we'd be allocating. But I think the real message which I wanted to give you was that it's more bottom-up, specific stocks, and then kind of and then aggregating it up rather than starting with a view that I want to be overweight financials or IT or industrials.